When assets and cash flow collide, what's the business value? Hi, this is Josh Horn, CPA of Horn Valuation. I help owners build, value, and sell their business. I get owners that come to me, they have a list of equipment. That may be you. You may have some heavy equipment or machinery on your books, and they say, okay, this is the value of my business because this is the value of the equipment. And presume we have no debt here. And they say, okay, this is the value. And I come back to them and I use an income approach and or a market approach, and I say the value is something different. Less, let's say. And they say, Josh, what gives? Why is that? Are they right or am I right? Or are we both right, depending on the circumstances? Let's take a look at this quickly, and I'm going to explain how you can deal with when assets and cash flow collide and how to make sense of it. Which one is correct? What I'm showing you first is a very oversimplified asset approach. We're just looking at all the equipment of the business, pretend there are no other assets and no other debt. And so we find out that the asset values of this business for all the equipment and all the machinery are $2 million. And presume that's you. And presume you think, okay, that's the value, right? Are you right? Let's take a look at an oversimplified income approach based on cash flow. That shows that the estimated value is $1.2 million. And the difference between those two is almost $750,000. And as I said in the opening, you may come back to me and say, Josh, what gives? Why? What happened? What happened to the value of my business? Let's talk about three things here. First, what's the premise of value? What's that mean, Josh? The premise is what is presumably going to be done with the business. Is the business going to be liquidated? You turn the key, you walk out, lights out, party's over? Or is it going to continue as an ongoing business, what we call a going concern premise? So is the premise of value liquidation or going concern? If it's liquidation, you may well be able to get $2 million for your business if somebody comes and pays for all the equipment at those values, there's no debt, walk away, bye-bye. That's the value of cash in your hand, before taxes, of course. However, many clients come to me and say, I want the business to continue to run. I may want an apprentice to take over, possibly a family member, some close employees, whatever the case may be. They want to continue to run the business. And in that case, cash flow and the market approach, which I haven't dealt with here, the values of similar companies, could have a much higher weight than the asset values. You can't run the business if you liquidate all the assets, right? So that's important. Second, can it be financed? Can a deal be done? Or more correctly, would someone do a deal with you? In this environment, likely they're going to try to borrow as much as possible with these low interest rates. So the amount of debt that they're going to take on has to be sustainable. Can they pay it back? The payback period, assuming 20% down on the deal, for a cash flow valuation would be approximately 7 years. The payback period on an asset valuation would be 13 years. The question you have to ask yourself is, who would do that? Who would borrow money over 13 years, take on that level of risk, and could the business even sustain that level of debt over a 13-year period? And that gets us back to cash flow when you're talking about a going concern business. That's typically going to be the driver of the value if you want it to continue to run. What about number 3? And this is going to be the fix. If you are in this situation, you're essentially upside down. How can you fix this? This is the key. Number 3, performance matters. We're going to take a look at this business's profit and loss or income statement. And if we make one adjustment here, which is not easy to implement, but you're going to see a big difference in how this comes out. Look what just happened. Because this business is now performing at a 10% pre-tax profit and now generating approximately $744,000 of cash flow, now the income approach value is almost $5 million, whereas the asset value is still at $2 million, putting them right side up almost $3 million. That would be approximately what the level of intangible value is in this business. Big change. And this is what I see a lot. I see a business that is doing okay, but not up to the level of the industry standard or where it could be. And if it's an asset-intensive business, a machinery-intense business, this can be a real issue. If you don't know what the benchmarks in your industry are, you can end up upside down. And to make matters worse, sometimes companies borrow money or the bank lends money based on asset values. And that can put you behind the 8 ball when it comes time to pay back your debt if you are not performing up to the level of your industry. And as it turns out, the gross profit margin is often the big driver. Very often. By driving that, in this case, up to 35%, I've talked about the 40-30-10 method before. In any case, we got to a 10% pre-tax profit margin that totally flipped this thing on its head because performance matters. This is what you can do when assets and cash flow collide and how to raise the value of your business. This is Josh Horn, CPA of Horn Valuation.